Most men can feel it now, even if they can't put a clean number on it. Something is off. The figures on your bank app look fine, but they don't carry the same weight they did 5 or 10 years ago. $100 at the grocery store used to mean a full cart. Today it barely fills a few bags. That is not a coincidence, and it is not your imagination. Then you look up and see the national debt pushing past $38 trillion. That number is not abstract anymore. It is a pressure point. People ask when it gets paid back, but that question assumes the old rules still apply. There is no verified plan showing how a debt of that scale is repaid through growth and taxation alone. What exists instead is financial engineering so complex that it barely resembles the system most of us were taught to trust. This is not the economy your father prepared for. The playbook of work hard, save patiently, and wait for stability was built for a different era. Today, the system rewards speed, leverage, and insulation from risk. Survival now depends on hedging against loss, not simply accumulating numbers on a statement. If you feel like the game is tilted, it is because it is being redesigned in real time. The goalposts are not just moving, they are being relocated while most people are still playing by yesterday's rules. Whether every outcome of this shift is intentional or fully understood is still debated, and in some cases, unproven. But the pressure is real, the erosion is visible, and ignoring it is no longer a neutral choice. This is the moment many men quietly realize that stability is no longer guaranteed by obedience to the system, only by understanding how it is changing. The $38 trillion soft default isn't a theory, it's a strategy. This is no longer economics. It's arithmetic. The United States has crossed into a debt structure that simply cannot be unwound through honest means. As of late 2025, the national debt has blown past $38 trillion. That's more than twice the entire GDP of the European Union. You will not hear this explained plainly on the nightly news, but here it is. There is no credible plan to repay it through higher taxes or spending cuts. None. Not one that has been verified, debated, or passed. Instead, the playbook quietly in motion is what insiders call a soft default. It's not declared. It's engineered. The mechanism is brutally simple. Inflate away the value of the debt. When inflation runs higher than the interest being paid, the real value of the government's obligations quietly melts. Let's be clear. If they borrow $1 today that buys a steak and pay it back with $1 tomorrow that buys a packet of ketchup, they've technically honored the debt, but they've robbed the lender's purchasing power. That lender is anyone holding dollars, anyone with savings, anyone on a fixed income. It's not a bug in the system. It is the system. This process, though elegant on paper, is economically violent in the real world. According to the Congressional Budget Office, the U.S. is currently adding debt at a rate of nearly $70,000 per second. Every moment you spend reading this, the hole deepens. And now, the fastest growing part of federal spending isn't Medicare or defense. It's interest on the debt itself. That's right, debt service just surpassed the Pentagon. That marks a dangerous threshold. We are now in what many economists call a debt spiral, a self-reinforcing loop where the government must borrow just to pay interest on its past borrowing. The only escape left is not productivity. It's currency dilution. That's not a conspiracy theory. It's the only lever left that doesn't spark riots or recessions. To keep the machine running, policymakers are quietly choosing inflation over default. It's politically invisible. It doesn't require a vote. It doesn't make headlines. But it destroys purchasing power just the same. If you've been wondering why your retirement feels like it's standing still, why food costs are rising even when inflation is cooling, or why hard assets like silver and gold are being quietly hoarded by central banks around the world, this is why. And while the details of future policy are still uncertain, and not all mechanisms have been confirmed, what is already happening is clear. The system is bleeding value faster than most people can protect it. The sooner you understand that we are not returning to normal, the better your odds of surviving what comes next. The invisible theft has a name and a balance sheet. Most people still think the U.S. government borrows money from real investors, from pension funds, from foreign creditors, from hard-working savers. That belief is dangerously outdated. Because what's happening now isn't traditional borrowing. It's monetized debt, and it's accelerate. Here's what that means. When private buyers, pensions, banks, even foreign nations, can't absorb the flood of treasury bonds hitting the market, the Federal Reserve steps in. But it doesn't do this with earned capital. It creates money from nothing, then uses it to buy government debt. That is not speculation. That is policy. This is modern monetary theory, MMT, in practice. The idea that a government that issues its own currency can never go broke. Sounds clever. But in execution, it's a quiet, sophisticated theft mechanism, one that drains purchasing power from anyone holding dollars. Every new dollar created makes the dollars in your wallet worth less. You worked for yours. They didn't. And here in early 2026, this isn't theory anymore. It's visible on the Fed's own balance sheet. In 2008, the Federal Reserve held under $1 trillion in assets. After the 2020-2021 pandemic stimulus and follow-up rescue operations, that number surged to nearly $9 trillion. Trillion, sir, you sigh. Why? After, that's not an emergency response. That's an entirely new operating system. Debt monetization is no longer a backdoor tool. It's Washington's default setting. Why? Because it avoids the political suicide of raising taxes or touching entitlements like Social Security and Medicare. But the cost still gets paid by you. They call it the inflation tax. It doesn't need a vote. It doesn't appear on your W-2, but it quietly erodes the value of every dollar you save, every check you cash, and every fixed income plan you built your future on. This is not a conspiracy theory. It is basic monetary arithmetic, and it's playing out in plain sight. Some defenders of the system will argue this is temporary, that the Fed can shrink the balance sheet when things stabilize. That may happen, but there is no verified plan for how to do so without triggering financial instability. Until then, the dilution continues. If you've been wondering why your paycheck buys less, why prices rise even when CPI reports claim normalcy, or why hard assets like gold and silver are being scooped up by sovereign buyers, this is why. The theft is invisible, but the effects are not. And every day you ignore it, the cost gets higher. Asset revaluation, Washington's quiet trick to shrink the debt without paying it. When a nation drowns in unpayable debt, it has two choices: earn more or change the scoreboard. America is choosing the scoreboard. As the U.S. debt barrels past $38 trillion, the system is running out of politically viable options. Tax hikes are a third rail. Spending cuts are electoral suicide. So now, the quiet conversation inside policy circles is turning to a less obvious maneuver: strategic asset revaluation. On paper, it's simple. The U.S. holds more than 8,100 tons of gold, but it still values that gold at $42.22 per ounce, a price set in 1973, frozen in time. At that valuation, the official gold reserve sits on the books at just $11 billion. That's not even a rounding error in the context of $38 trillion debt. But what if that gold were revalued to $10,000 per ounce, a figure that has been quietly floated in certain institutional models? Overnight, the same metal would now appear as $2.60 trillion in federal assets. Just like that, the balance sheet looks less catastrophic. No new gold mined. No wealth created. Just a paper gain. A fiscal mirage. This isn't new. In 1934, President Roosevelt executed a similar maneuver, revaluing gold from $20.67 to $35 per ounce, a 69% increase to help offset Depression-era debts. It was sold as stabilization. It was, in effect, a stealth devaluation. And now, the playbook may be expanding into the digital realm. The U.S. government reportedly holds over 210,000 Bitcoin, seized from criminal operations and currently valued at $21 billion, assuming a $100,000 market price. But here's where it gets even more speculative, yet strategically plausible. If the Treasury reclassifies Bitcoin as a strategic reserve asset and marks it to a higher internal price, say $500,000 per BTC, those same holdings would appear to be worth $100 billion. That's not real wealth. That's spreadsheet theater. Just a reshuffling of numbers to make a $40 trillion liability pile look less unmanageable. No debt repaid. No productivity gained. Just accounting smoke and mirrors. It signals something deeper: the death of hard money discipline and the rise of balance sheet cosmetics. We are now witnessing a game where assets aren't revalued based on market function or productivity, but based on political utility. Is this confirmed policy? No. The Bitcoin revaluation scenario in particular remains speculative, but the gold valuation reality is documented. And the logic is clear. In a world built on confidence, optics matter more than solvency. If you still believe reserve assets are fixed anchors of value, understand that they are now being quietly weaponized to buy time. And every time they move the benchmark, the currency you hold gets one step closer to abstraction. This is not about creating wealth. It's about masking weakness. And the longer it goes unnoticed, the more likely it is to happen again. The Japan shock, when the global ATM shuts down. For over 20 years, Japan has been the silent engine behind Wall Street's free ride. While the headlines focused on Washington and Frankfurt, Tokyo was quietly fueling the global asset boom. How? With zero interest rates and, in many cases, negative rates. This allowed investors to borrow cheap yen, convert it into dollars, and flood the U.S. with liquidity, buying everything from stocks to real estate to crypto. The yen carry trade wasn't a footnote. It was the hidden foundation under decades of Western market expansion. But in early 2026, that foundation cracked. The yield on Japan's 30-year government bonds surged to 3.5%, a level not seen since 1999. This was not a random market movement. It was a tectonic shift. Because when Japanese yields rise, the entire carry trade flips. Borrowing in yen is no longer cheap. It becomes painful. Investors who once took easy leverage now face a global margin call. They're being forced to unwind positions, selling off U.S. stocks, dumping real estate, liquidating crypto, to cover yen-denominated losses. The cost of money just changed. And when the cost of money changes, everything reprices. This is more than a market correction. It's a liquidity collapse rippling from Tokyo to New York. But that's only half the danger. Japan is not just a lender to Wall Street speculators. Its massive life insurers and pension funds are also among the largest foreign holders of U.S. treasuries. When domestic Japanese yields rise, those institutions are incentivized to pull capital back home, a process known as repatriation. If Japan starts selling treasuries, or even just stops buying, then the U.S. faces a problem. To keep financing America's deficit, interest rates must rise sharply to attract new buyers. That's how you crack the U.S. housing market. That's how regional banks start to bleed. This is not theoretical. We saw the first tremor on Black Monday, August 2024, when a mere 0.25% rate hike by the Bank of Japan sent shockwaves across global markets. Today, with yields at 3.5%, the pressure is 10 times worse. It's not just about Japan. It's about the role it played as the world's silent liquidity source. That tap is closing. And as it does, the world must confront a hard truth. Western markets were never as self-sustaining as they look. If Tokyo pulls the plug, Washington will need to pay more to borrow, print more to cover the gap, or watch key markets break under pressure. None of those paths are clean. All of them lead to pain. Note, the full scope of Japan's repatriation plans and its internal policy response are still evolving. But the direction is unmistakable. The world's global ATM is shutting down, and the bill is about to land in the inboxes of U.S. investors, homeowners, and the silver shock has arrived, and it's no longer just about price. While mainstream investors obsess over gold, ETFs, and Bitcoin halvings, silver is quietly becoming the most weaponized asset on Earth. And in early 2026, it delivered a shock that stunned even hardened commodities traders. For a brief moment, silver surpassed Nvidia to become the second largest asset class on the planet by market cap, second only to gold. This wasn't a meme rally or retail frenzy. It was the result of a crippling, real-world supply shock, the kind that forces governments to act and changes entire energy strategies. Here's what triggered it. China, which dominates global silver refining, implemented strict export licensing controls in Q1 2026. This effectively choked off Western access to refined silver at a time when demand from solar, electric vehicles, and AI data centers is exploding. Silver isn't just a precious metal anymore. It's now a strategic input for future industry. And when the industrial sector and the investor class are both chasing the same shrinking pool of physical ounces, price becomes secondary. Survival becomes the driver. But the most jarring development isn't coming from Beijing. It's coming from inside the United States. According to rumored internal documents from an emergency Jackson Hole summit, a confidential program known as Operation Silver Shield may be underway. This alleged plan, not yet publicly confirmed, would involve the Federal Reserve acquiring a 500 million-ounce silver stockpile as a new strategic reserve, surpassing even gold in priority. Why? Because silver runs the modern world. Without it, there's no clean energy transition, no advanced semiconductors, no military-grade electronics. And unlike gold, silver's dual role, monetary and industrial, makes it almost impossible to replace. Internal modeling, again, not officially released, suggests that if the U.S. government enters the market as a direct buyer of 500 million ounces, which exceeds total annual investable supply, the price could skyrocket to $267 per ounce. That's not speculation from a newsletter. That's a potential repricing event with the force of national policy behind it. If true, this would mark a seismic wealth transfer, from the digital paper markets to those holding physical metal. ETF shares and COMEX contracts would be left chasing a physical inventory that no longer exists at the old price. This isn't a prediction. It's a paradigm shift already in motion. And the implications are global. Industrial buyers are being outbid by sovereigns. Western refiners are running months behind on delivery timelines. Strategic metals are being hoarded, not traded. And the Fed, long dismissive of silver, is now allegedly planning to front-run the market it once ignored. Caution. Operation Silver Shield has not been publicly confirmed. The source documents remain unverified in the public domain, and all references to the Fed's internal price modeling are based on rumored leaks. But even if only part of it is true, the message is clear. Silver has gone from being a forgotten cousin of gold to the backbone of 21st century infrastructure. And the governments of the world are no longer ignoring it. They're stockpiling it. The petrodollar's crisis moment, Venezuela, oil, and the global power shift. For more than 5 decades, the US dollar's dominance as the global reserve currency was anchored by the petrodollar system, the implicit rule that oil sells in dollars. That rule didn't just lubricate global trade. It financed American power. It forced global demand for dollars. And it funded US deficits with foreign capital flowing back into treasuries. But that era is cracking. Countries around the world have been quietly settling oil in other currencies for years. China's yuan, Russia's ruble, and even barter arrangements, shrinking the dollar's monopoly on energy settlement. Venezuela, sitting on the largest proven oil reserves on Earth, had gradually moved parts of its oil sales outside the dollar system in recent years as sanctions and economic isolation pushed it deeper into alternative trade structures. Then, in January 2026, everything escalated. The United States conducted a military operation in Venezuela, capturing President Nicolás Maduro and bringing him to the U.S. to face federal charges. A dramatic move that shocked global capitals. To be clear, the U.S. justified the action as a crackdown on narco-terrorism tied to drug trafficking. As some analysts outside official channels argue, the oil currency angle was a strategic driver, though this interpretation remains unverified and debated among experts. But here's what we do know from current reporting and policy moves. 1. The U.S. has asserted control over Venezuelan oil sales. Washington states it intends to control Venezuela's oil exports indefinitely, routing revenues through U.S.-approved channels and involving American oil companies in rebuilding production capacity. This isn't just diplomacy. U.S. energy policymakers are discussing coordinating Venezuelan oil sales to serve American strategic interests, even while easing some prior sanctions. 2. The intervention sparked global reactions. Rather than reassuring markets, the operation has fueled calls among nations, including China, Russia, Brazil, and Indonesia, for alternative payment systems and financial architectures that don't depend on the US dollar. 3. The narrative of force over economic logic has damaged confidence. When the world sees a superpower using military and legal force to enforce economic outcomes, whether justified or not, it accelerates the desire to diversify. Many countries no longer want their energy trades priced solely in a currency backed by armies and sanctions, rather than by economic fundamentals. 4. Safe haven demand is rising. Gold and other hard assets have climbed as global players brace for a world where the dollar is just one of many currencies, not the unquestioned king. This trend helps explain why gold surged above $4,400 and silver spiked above $70 in early 2026, as investors and nations alike price in a future of multipolar currency competition. Note, specific price targets may vary with market conditions and are subject to change. This is not simply about oil production volumes or short-term price swings. Even though Venezuela's actual oil output remains well below its theoretical potential, due to decades of underinvestment and structural problems, the symbolic impact of losing control over one of the world's largest oil reserves geopolitically. In other words, the risk is not just that the dollar loses share. It's that its reserve status is increasingly seen as something maintained through power, not preference. And when markets see power as coercion instead of consensus, they start hedging their bets, often in gold, other currencies, and alternative payment systems. Whether Venezuela's decoupling from the dollar was the reason for the U.S. operation, or whether the intervention was primarily about energy politics, remains a subject of debate and lacks full independent verification. But the global response makes one thing clear: the petrodollar era isn't dead yet, but its foundations are eroding in plain sight. The paper trap: how the banking contagion could freeze your wealth overnight. The modern banking system was built on one fatal assumption: that interest rates would stay low forever. That assumption is now dead, and the consequences are cascading. With bond yields surging, banks around the world are sitting on hundreds of billions in unrealized losses. These are the same bonds they loaded up on when rates were near zero, now deeply underwater. On the surface, they haven't lost the money yet. But if they're ever forced to sell to meet withdrawals or margin calls, those paper losses become real. But that's just the surface layer. Beneath it lies a far more dangerous structure, the global derivatives market. Valued at anywhere between $600 trillion and $1 quadrillion. It functions as a massive, unregulated shadow system, sensitive to interest rate spikes, currency volatility, and liquidity crunches. The collapse of a single major hedge fund, especially one exposed to the yen carry trade unwind, could trigger a chain reaction up the financial food chain, eventually infecting the too-big-to-fail banks that underpin the global system. This is the contagion scenario no one wants to talk about. Because once it begins, it moves faster than regulators can contain, and deeper than most investors are prepared for. And that's where the paper trap springs shut. Many investors think they own gold or silver. But what they really own are paper proxies, F shares like GLD or SLV, or pooled accounts run by institutions. These vehicles are fine in calm conditions, but in a real crisis, they carry counterparty risk that most people ignore until it's too late. Imagine this. Silver spikes to $200 an ounce due to a physical shortage, but SLVB, your paper investment, is still trading at $70 and redemptions are suspended. You're locked in. Why? Because the underlying fund can't source physical metal. Why? Because it's already been absorbed by sovereign buyers like China or, if rumors are correct, by a U.S. Strategic Silver Acquisition Program, see Operation Silver Shield. In that moment, your wealth is trapped inside paper promises, while the real metal vanishes from the market. That's not fear-mongering. That's what happens when demand for real assets collides with a leveraged system built on assumptions of infinite liquidity. That's why smart capital is already moving. We're seeing a flight to quality. Investors quietly taking physical delivery of gold and silver bars, locking in real custody, and insulating themselves from ETF rehypothecation risk, brokerage freezes, and banking system stress. Because when the reset comes, and it will, whether gradual or sudden, only those holding assets outside the system will have leverage. Not all ETFs will fail. Not every bank will collapse. Not every derivative will trigger contagion. But the risk is no longer theoretical. It's built into the system and rising by the day. If you're holding wealth in paper and trusting counterparties you've never met, now is the time to ask a brutal question. Will your assets still be accessible when everyone wants out at once? Because in the next stage of this crisis, paper wealth isn't just vulnerable, it's expendable. The end of empire. Why 2026 marks the peak of a 250-year cycle. History doesn't repeat, but it does rhyme with ruthless precision. And the rhyme in 2026 is loud. Across thousands of years, from Mesopotamia to Rome, from the Dutch Republic to the British Empire, every superpower has followed the same script. Economists and historians have studied this arc and found a striking pattern. The average lifespan of a dominant empire is about 250 years. Not 1,000. Not forever. Just 10 generations, enough time for strength to become arrogance and prosperity to become rot. The United States, founded in 1776, hits that exact 250-year mark in 2026. And the signs of terminal decline are not hidden. They're flashing in plain sight. Massive debt and deficit spending. Currency debasement through endless printing. Military overreach with no clear objective. A fractured, distrustful society collapsing inward. Historians call this stage the Age of Decadence. We are not entering it. We are already living in it. The parallels to late-stage Rome are impossible to ignore. The Roman state debased its own currency, diluting silver coins with copper to pay for endless wars, bloated bureaucracies, and crowd-pleasing distractions. Bread and circuses wasn't just a cultural moment. It was a last resort economic strategy, one that eventually collapsed the empire from within. We are making the same mistake, but this time it's global. We tell ourselves the dollar is different. That because it's the world's reserve currency, we can print endlessly without consequence. That deficits don't matter. That trust is automatic. That decline can't happen here. The Romans told themselves the same thing, until their merchants refused to accept devalued coins. That's what we're seeing now, globally. Nations around the world, China, India, Saudi Arabia, Brazil, are quietly shifting away from U.S. debt and the dollar system. They're pricing oil and other currencies. They're accumulating gold. They're watching the headlines and asking, if America no longer respects its own financial limits, why should anyone else? Let's be clear, 2026 is not a doomsday prophecy. But it is a marker, a historical milestone when math, trust, and empire timelines all intersect. Debt has crossed the point of no return. Currency dilution is being normalized. Social trust is collapsing, and the illusion of control is cracking. When history reaches the 250-year moment, repricing happens fast. The world doesn't wait for permission. It adapts. And those clinging to the rules of the old system, the rules of empire, are the ones most exposed when the reset begins. If you're holding savings in a system past its peak, if you're relying on paper promises in an era of broken trust, you may already be living inside a moment your grandchildren will study in textbooks as the end of an age that thought it would last forever. When the illusion ends, what will be in your hands? We are standing at the edge of a financial era, one that history has visited countless times before. The tools may now be digital, the debt figures measured in trillions, but the core deception remains unchanged. You cannot print your way to lasting prosperity. You can only delay the reckoning. Today's $38 trillion bread burden isn't being solved. It's being repackaged through inflation, monetized through currency dilution, and masked by strategic asset revaluations that make balance sheets look stronger, without producing a single ounce of real value. This isn't about beating the market anymore. That game was built for another time under different rules. This is about survival through the great repricing. A repricing not just of assets, but of truth versus illusion, of real versus synthetic wealth, of what you actually control versus what you were told you own. And when the dust settles, when ETFs suspend redemptions, when yield spikes tear through derivative chains, when governments race to secure what's left of the physical, will it be paper? Or something no central bank can devalue with a keystroke? We are not predicting a single moment of collapse, but we are living through the slow, grinding erosion of a system that overpromised and overleveraged itself into fragility. The warning signs are everywhere. Central banks hoarding gold at record levels. Sovereigns bypassing the dollar in oil trade deals. Physical silver premiums decoupling from paper prices. Derivatives markets one unwind away from cascading failures. Each of these signals points to the same conclusion. The era of paper confidence is closing, and those who understand history are quietly repositioning. So the real question isn't whether you can spot the trend. It's whether you're positioned on the right side of it when the music stops.